Ladies and gentlemen, good day and welcome to Oriental Carbon and Chemicals Limited Q2 FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Akshat Goenka, Promoter and Joint Managing Director of OCCL. Thank you, and over to you, sir.
Good afternoon and a very warm welcome to everyone. Along with me, I have Mr. Anurag Jain, CFO, and SGA, IR advisors. We have uploaded our results and investor presentation on the stock exchanges and company website. Hope each one of you had a chance to go through the same. We are witnessing a challenging global environment characterized by elevated inflation, lower demand, and realizations of chemicals globally. During this year, we have witnessed lower export demand from Europe due to the weakening economy, resulting in lower sales volume in the current 6 months compared to the previous 6 months. Revenue was lower also due to decrease in sales realization on account of decrease in input cost. However, profits for H2 as well as Q2 are better than last year in the same period. We believe the company is capable of withstanding short-term volatility caused by external factors and will continue to grow going forward as things begin to normalize. In the domestic market, we anticipate growth in IS demand in next year on the account of growth of automotive industry due to expanding vehicle ownership, growth in EVs, and the increasing use of commercial vehicles in logistics and e-commerce, as well as the realization in commercial tires. The government's emphasis on major infrastructure projects should drive up the demand for heavy commercial vehicles. Considering the prevailing economic conditions, the potential scale of opportunities on the horizon is very high. According to the data published in H1 FY24, passenger vehicle sales increased by 6% year-on-year, commercial by 3.3%, and two-wheeler increased by 7%. The Indian tire industry is currently thriving and displaying growth and resilience, fueled by a combination of factors including robust domestic demand, export opportunities, and technological advancements. During the year, we aim to grow our market share by expanding into new areas like North America and with acquisition of new customers. Additionally, we are focused on increasing our revenue share in India. Our ongoing objective remains the increase of our market share on a global level, aiming to raise it from the current 10% to 12%. OCCL has always been focused on delivering stakeholder value with emphasis on sustainability in line with our commitment. We have received recently the letter for conformance for Sustainability Procurement Management System during the current period. This is a very prestigious award and very few people have it. We also have received Great Places to Work second time in a row with higher numbers. The other good development that has happened in this H1 is we have prepaid a lot of our debt with the existing cash flow. The Board of Directors have declared an interim dividend of Rs 7 per equity share of face value Rs 10 each of the company. With this, I would like to hand over the line to Mr. Anurag Jain to update you on the financial performance of the company.
Thank you, Akshat. I will take you all through the standalone financials of the company. First, I will give you a highlight of Q2 FY24. Total income for Q2 FY24 stood at Rs 95.7 crores as compared to Rs 123 crores in Q2 FY23, a degrowth of 52% year-on-year. EBITDA for Q2 FY24 stood at Rs 21.7 crores as compared to Rs 21 crores in Q2 FY23, a growth of 3% year-on-year. EBITDA margin stood at 22.7%. Profit after tax for Q2 FY24 stood at Rs 8.3 crores as compared to 7.8 crores in Q2 FY23, a growth of 6% year-on-year. PAT margins stood at 8.7%. As far as the half-year ended FY24 performance is concerned, total income for H1 FY24 stood at Rs 206.1 crores as compared to rupees 260.9 crores in H1 FY23, a degrowth of 21% year-on-year. EBITDA for H1 FY24 stood at rupees 54.3 crores as compared to rupees 49.4 crores in H1 FY23, a growth of 10% year-on-year. EBITDA margin stood at 26.3%. Profit after tax for H1 FY24 stood at rupees 23.6 crores as compared to 21.7 crores in H1 FY23, a growth of 9% year-on-year. PAT margins stood at 11.5%. With this, I would like to open the floor for questions and answers.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take our first question from the line of Mr. Aditya Ketan from Swiss Institutional. Please go ahead, sir.
Yeah, thank you, sir, for the opportunity. Sir, first question is, sir, what would be the utilization level for our first half as compared to FY23 levels? Only the utilization level, sir.
We do not give the exact sales figure, and therefore we cannot give the utilization level because that will reflect the exact sales figures. But I can tell you that the quantities sold were lower from last year by about by about 10%.
By about 10%. Okay. And sir, in your opening remarks and also into the presentation, we have stated that we are looking to increase our global market share from 10 to 12% this year. So, sir, like the incremental capacity which we have added, you had stated that we have not got orders for that capacity. So, at least for the 9 months, we were not looking to book any orders. So material uptick in volume shouldn't be there for this fiscal. So how come our market share from 10% to 12% it can go?
So what we are saying is that we are looking at doing this. So basically our aim is to grow to that 12%, and our target is to do it in calendar year 24.
Okay. Yeah. And sir, what is the status of the new capacity expansion? So have we received any new orders so we can so ramp up the capacity faster than anticipated?
No. So currently, as I told you, there has been some decrease in quantities. And in calendar year 24, we are looking to increase our wallet share in the global capacities. And that is when we expect to increase our capacity utilization. Post that, we can consider the further expansion.
Okay. Sir, also the European markets and the US market, so that continues to remain weak. So is there any so suppose into a cycle, so where are we standing now? We are at the bottom, or we could see further pain, or because of anticipated pickup in demand from tire front, there should be pickup. So where are we standing in terms of a cycle?
So what I would say is that, most of the geopolitical situations have played themselves out. And therefore, I would tend to believe that as far as the European market is concerned, this could be a place from where we could witness a little upside, after some short period of time, not immediately, but maybe after 6 months. I do not see any further issues happening here, except for the fact, of course, that there is one geopolitical situation of the Gaza-Israel war. If that does not escalate, then we feel that, as far as Europe is concerned, that this could be it.
Okay. Okay. And sir, into the North American market, earlier, sir, we were stating that it is a 40,000 tons market. So how much penetration we have made? How much volumes are we giving? Any sort of a market share number you can give in North America?
Once we make the penetration, we will share the number with you. But currently, of course, we are looking to enter this market. We have not been successful enough to share the number with you.
Okay. So just one last question, sir. Have you heard any competitors expanding the capacity further from the current level?
So we have heard of a Japanese competitor who have stated their intention to expand capacity by about 10,000 metric ton per annum. Okay, 10,000 metric tons. Any other player? So Flexis, have they indicated any sort of capacity expansion? Not to our knowledge.
Okay. So sir, we can anticipate that the capacity addition would be limited at least for the next 2 years, and considering that the demand growth, so whatever there was capacity surplus, that can be fulfilled at least over the next 2 years.
That is what we are hoping for. That additional capacities, if there is a demand growth and the geopolitical situation stabilizes, then the pressure on capacity utilization should ease down a bit.
Okay. Thank you, sir. Thank you.
Thank you, sir. The next question is from the line of Mr. Narendra from Robo Capital. Please go ahead, sir.
Hi, thanks for the opportunity. So my first question would be, what kind of volume growth are we looking for in the next a couple of years, 2-3 years, if you could provide a little guidance on that front?
So what we are looking for and what we are gunning for is to utilize our current capacities in the next 2-3 years.
We also have the approvals in place to sell out our entire current capacities. It is, and we've had this in place even last year. It is not necessarily a new development. Last year we were not able to get allocations, and there were slowdowns and various things. So we are hopeful that at some point we will get those allocations and be able to sell out the entire capacity.
Okay, that helps. And on the realization front, sir, are we at the bottom, or is there any further possibility of decline, and what's the outlook going ahead?
So as far as the realization is concerned, as you can see from our profitability, basically realization is also a product of the input costs. So for example, even though realizations came down significantly from last year, but last year they were higher because of the raw material cost, and the raw material cost came down. But in spite of that, we were able to regain some of our margins over last year. Now, looking at the margin scenario, I would tend to believe that this is a level where it should stabilize. The sales of AlphaStreet, that is, should stabilize.
So, whatever the
reduction in the market demand over next year also, then there could be additional pressure on the margins.
Okay. So, how much of the input cost changes are you able to pass on to your customers? If you could throw some light on that.
So normally raw material input cost changes are passed on either way to the customer. But there is always a lag because we have a quarterly or a 6-monthly contract with them, and in some cases annual also. So it depends on the next cycle discussions. Whenever we do negotiations, input costs form a part of that negotiation.
Okay, so they have passed on, right?
So I would not say that 100% passed on either way.
But the margins are somewhat...
They are always considered, during negotiation.
So the margins are, somewhat protected on that front. Is that right to assume?
I didn't get your question, please.
Sorry, I said that the margins are somewhat protected. Is that right to assume that?
So as I said, for example, last year the margins were quite squeezed. This year they have improved a little bit. So this is how this happens,
Okay, got it.
What is the price that they are buying at? They will consider what is the input cost scenario, what are the competitors. All these things, go into negotiation. It's not only the input cost. Yeah.
Got it. Thank you. Thank you so much. All the best.
Thank you, sir. The next question is from the line of Keshav Garg from Counter Cyclical. Please go ahead, sir.
Sir, I'm trying to understand that quarter on quarter, if we see our revenue is down 13% on standalone basis, whereas our EBITDA is down by almost a third. So what is the reason that the quarter on quarter, why is there so much impact, especially on the EBITDA level? Has the demand deteriorated quarter on quarter?
Quarter on quarter. Yes, so quarter on quarter, as you said, that there has been some reduction in the quantity as well as selling price. So therefore, there is a reduction in quarter on quarter. There is just one.
Sir, I meant as compared to June quarter with September quarter, Q2 versus Q1.
Yeah.
Sir, in Q1 on standalone basis, we did 31 crore EBITDA, which is down to 21 crore in Q2.
So what major reasons? One is the quantity, and one, of course, in Q1, our margins were very good, which have come down in Q2, even though they are better than the Q2 last year, but they are lower than Q1 of the current year.
Sir, so now, sir, is it due to operating deleverage kicking in, or is it due to that we have passed on more price reduction than our cost reduction?
No. So as I said, the pricing changes happen on either quarterly or half-yearly basis. So wherever there was a half-yearly pricing change, that came into effect from 1st July. And the pricing change was passed on. So that is why the impact of that is there in the quarter ended 30th September.
So now going forward, what is the kind of feedback you are listening from your customers? Are you expecting the same trend to continue? Should we expect the Q2 numbers trend to continue, or do you see this trend changing or further deteriorating or improving?
So our effort is to increase our quantities. That is the quantity that we sell. And when we achieve that, obviously, our EBITDA numbers should look better.
And sir, now as far as the realizations are concerned, should these realizations be considered to be the rock bottom, or is there still further scope of realizations going down further?
We hope that doesn't go down further. As I said earlier also in response to another question, that if there is no further impact in the demand, our hope will be that the realizations that we have now should be the realization that should continue. Sustain, that is.
The line for the current question has got disconnected. We move on to the next question from the line of Mr. Neerav from Annual Research. Please go ahead, sir.
Yeah, good afternoon, sir. So I have two questions. So one is, a few years back when we were speaking about competition from China, so predominantly they were not on the continuous process, and possibly because of which their realizations were also lower as compared to ours. But when we now see for most of the companies there, they have now been on the continuous process. So latest being Young Hutai, who has put up a 40,000 ton capacity last year on a continuous process. So just wanted to understand from you that, let's say before 3-4 years when we were selling in the market and they were also selling in the market, those premiums, what we used to get, has that narrowed down at this point of time with Chinese becoming more aggressive in terms of setting up their capacities on continuous process? So that's question number one, sir.
So this has to be answered in two ways. There are certain areas in which the Chinese have got approvals, and there certainly the premium has been compressed. And there are other areas where the Chinese are not, approved or not considered a very reliable source of supply.
Yeah.
So it is not a question of premium getting compressed or not, because one is not competing with the Chinese.
Correct.
Where one has a direct competition with the Chinese, there certainly the premium has got compressed.
Got it. So, sir, when we see our portfolio of products, we generally are more towards high dispersion, high stability grades or the special grades. So, let's say out of the total volumes what we currently sell, of that portion, how much is immune from those competition levels where we...
No, there is nothing like that now, because the OT20 product has become everything has become a so-called special product and everybody has it. Okay. Then there are other products like OT25AS and OT33 where the Chinese are not present, to answer in short.
Got it, sir. And another question from my side is, if you can share about the world market currently, how much of the capacity is now in China, how much is the consumption currently in China? If you can just share some broad picture about the global market and how the market has been growing over the last 3-4 years.
So, these are numbers which are not readily available with us.
Just a broad perspective you can share.
So the broad perspective is that there has not been any growth in China in terms of what we hear of in terms of consumption, and that is why the Chinese manufacturers have been a little bit more aggressive for selling into the Asia Pacific region. And world over also, in the last 2 years, we do not see any growth because we have seen compression in the European market. China has not grown, or if they have gone slightly over this, in the current year, they are still below the 2019 numbers. So it's very difficult to say, but if you ask my gut feel, then there has not been any growth in the global market this year.
Okay. Because I was going through one of the articles which were mentioning that in July, August, the tire volume growth in China was 10% up on a YOY basis, as well as it was about 2018-19 levels also in terms of the growth. And they have been now taking those price hikes also commensurate with the increase in the raw material prices. So here probably sulfuric acid prices have not gone up, so they would not have taken those price hikes. But for other constituents... Sorry?
You are talking about sulfuric acid or sulfur?
No. I am talking about sulfur, so my apologies. So for sulfur, last year the prices were higher, then it came down. So there the question of price increases were minuscule, but for other constituents of tire where the rubber chemical goes, they have been managed to increase those prices of the finished product. So just wanted to understand your perspective that the second half looks better for the entire industry, where the volume which we have clocked in Q2 could be considered as bottom volumes, and now we could start seeing those ramping up of our sales quantities also to the export markets.
So I will answer you in two parts. Again, as far as global market is concerned, I would not be able to comment whether the global market will immediately increase in the second half. Even though there has been uptick in the Chinese market in the last quarter, but when I was talking about the whole year. Yeah. As far as our own performance is concerned, yes, you are right. We should assume that what we have sold in the preceding quarter is something that we should improve upon in the next quarter. So that is how this should happen.
Correct. And so just a last clarification on that 40,000 tons of capacity which a competitor has put up in China. So do you have any idea about that capacity being put into operation or how it is operating, or has that suppressed some of the realizations in the export market? Any idea? That would be very helpful, sir.
So you're talking about Huatai. Huatai is competing in the market wherever they are approved, as Akshat just told you.
Yeah.
So Huatai is competing in the market. Their product is acceptable and approved with certain customers, and there, of course, we have to, consider their pricing also. Correct. Now, whether this is coming from the new capacity or how much is their capacity utilization is some figure which we don't have currently. Maybe by the end of the year we will have those figures.
Got it, sir. Thank you so much, sir, and festival wishes and all the best for the coming quarters.
Thank you. Thank you.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 on the touchtone telephone. We take the next question from the line of Karan Mehra from Mehta Capital. Please go ahead, sir.
Hello, sir. Good afternoon, and thanks for the opportunity. A couple of questions from my end. Sir, have we seen any cost reduction on the raw material front, given that we are seeing easing in inflation?
Year on year, obviously, there has been a substantial cost reduction. But if you talk about cost reduction in the current, and even I would say a little bit from quarter to quarter, but now they are more or less stabilized. So within the last 4 months, 5 months, they are more or less been stable with a slight upside on some raw materials, slight downside on some raw materials.
Understood. And so with increased radialization, how much excess demand are we seeing for insoluble sulfur going ahead?
So there are, we do expect the domestic market to grow robust, and the growth rate being robust. And there are many factors, of course. There is the increased auto sales, increased infrastructure spending, increased use of commercial vehicles, and radialization of commercial tires. Obviously, the radialization of passenger vehicle is complete. So these are the commercial tires where again rapidly radialization is happening. So that will add in the overall addition of demand for insoluble sulfur. But to say how much percentage will that constitute is difficult to say.
Sir, so are any of your peers planning to increase capacity in near future, and how will this impact us in future?
As I have said earlier, the only capacity expansion that we are aware of is that of the Japanese competitor. We have declared a 10,000 metric ton expansion plan.
Sure, sir. That answers my question. Thank you, and all the very best.
Thank you. We take the next question from the line of Mr. Keshav Garg from Counter Cyclical. Please go ahead, sir.
Sir, I'm trying to understand that, sir, what approximately would be the global capacity utilization for insoluble sulfur industry? Hello.
Global capacity utilization, I cannot give you that figure just now. I will be, because I have not total the global capacity. I don't have the total global capacity in front of me. But we can get back to you on that.
Sir, so what are you hearing from your customers when they must be demanding for a price cut due to increase in competitive intensity? Sir, so that would give you some idea about so what would you say that how much is the excess capacity globally?
So if we say, whether capacity utilization or excess capacity globally, it's the same thing. Yes, we know that there are unutilized capacities. Yes, we know that there is a pressure from unutilized capacity in China, but if you ask me as a percentage, that is something I cannot give you offhand. So these are the two things. Whenever we talk to customers, there are some customers where we have the Chinese competitor, there the talk is different. Elsewhere, they do talk about costs coming down, and there are other ways of negotiation. But to say, everybody talks about our customers talk about excess capacity is not correct. because where we have long-term relationships, it's always about input costs coming down and adjusting the price and things like that.
Sir, so this increase in market share from 10% to 12%, by when do you foresee this happening? In how many years?
So our target is to have that by the end of calendar year 24.
So, and most of this increase is expected to come from the USA?
Well, our increase is coming from new markets, which predominantly is North America. In addition to that, we are looking at entering with some new customers. That is the second thing. The third thing is that we are looking at increasing our wallet share in the domestic market, which again is the fastest growing market in the world today. So that should also add to our overall market share, global market share.
Sure, sir. And sir, also, sir, is there any continent that we have not penetrated at all, like for example, Latin America, Africa, or?
We are present in all continents today. If you ask me, we are selling in all continents today.
China is the only place we are not present.
Okay. And sir, what about the Russian market, sir? Are we over there since the Western competition has withdrawn completely from that market?
So that is this is a matter of sanctions and all that.
Okay. And sir, finally, sir, in the insoluble sulfur that we are manufacturing, sir, are there any adjacencies where we can try to modify our products or make some derivatives or some value addition? And sir, or is it only the tire sector that this product can find application, and there is nothing else? Sir, in sulfur chemistry, I'm assuming there must be other areas, adjacencies, which we might.
What happens is that sulfur is available, for example, today. Sulfur is available at around 14 to 15 rupees per kg. Our product is say 8 to 10 times that. Sulfur works as a vulcanizing agent. So only the tire companies where the rubber performance, the tire needs to perform at very extreme level. So it is only there that people will buy an expensive product.
So basically, rest all the applications are low value added, so it doesn't make sense for us to look at them.
So low value, no. What I'm saying is that they will not use insoluble sulfur until and unless the product that they make is the kind where rubber has to undergo, the vulcanized rubber has to undergo extreme environments.
Sure, sir. And sir, by when do you foresee this demerger finally taking place?
So the matter is in front of the NCLT court, and they have to give the approvals. Once we have the approvals from them, then it will move forward.
Okay, sir. Thank you very much. That's all from my side.
Thank you.
Thank you, sir. The next question is from the line of Aditya Ketan from Smith Institutional. Please go ahead, sir.
Yeah, thank you, sir, for the follow-up. Sir, as you mentioned that, so the sulfur prices generally they are at around 10 to 12 rupees per kilo. So, sir, similarly, how much?
12 to 15. I did not use the word 10.
Okay. And sir, so sir, similarly, how much would be the coating oil prices also per kilo, if you can specify a range also for that?
Say from about 100 rupees to 135 rupees a liter, not kilo.
100 to 135 per kilo?
Yeah. Okay, you can say per kilo, right.
Okay, 100 to 135, okay. Sir, for the full fiscal FY24, so I believe half yearly we are down by 10%. So for FY24, we are building in a flattish volume growth as compared to FY23. So there should be uptick in second half, or we would still be down at around at 5 to 10% for full fiscal FY24.
No, we hope not to be down, and we hope to be better than FY24 quantity terms.
And sir,
in FY24, in quantity terms, than last year.
Okay, so that means that so there would be a volume growth of around 15 to 20%. You mean to say in second half, like we are down by 10%?
Even last year, the second half volume were lower than the first half volume. So that is one thing, and then obviously we are looking at increasing our volumes in H2.
Okay. And sir, this volume uptick which you are mentioning in second half, so this should be largely led by the newer capacity or from the existing capacity only we would be getting?
It doesn't matter, because what matters is what percentage of capacity utilization is there, right? So whether we are using the old plant or the new plant, that is something that we keep using. Even now at lower capacities, we are using the new plant also for production.
Okay. Other expenses part on quarter, there is a jump of 4% despite declining the top line and your volumes by 10%. So I think the freight cost and power cost also have been normalized. So which is that component which has gone up in this quarter?
So one of course is that we had an annual shutdown at the sulfuric acid plant, so the repair and maintenance costs are higher. You're talking about the steel question, right?
Quarter on
quarter.
Okay.
Okay. And then obviously the normal growth in the normal inflation and salary growth is there. Some repair and maintenance costs are higher. These are the major this thing.
What would like 3-4 crores or something?
Okay.
So 3-4 crores, right, sir?
Just give me a moment. अगर एक्सपेंसिव में कहाँ पे ग्रोथ है आपको दिख रही है? मुझे समझ तो ये क्वार्टर ऑन क्वार्टर बोल रहे हैं या पिछले क्वार्टर?
Quarter for 4%, and even if you look on the half yearly basis, so it is down by around 30%. But sir, our volumes are down only by 10%. So this additional decline in other expenses,
the additional decline is basically because of freight, which was very high last year. This time last year. So the major component is freight in that.
But okay, so but the majority of the freight in the.
So freight has come down, quite substantially, from around 56.5 crores to 9.5 crores.
Okay, 16.5 to 9. Okay, 9.5.
56.5 to 9.5.
So freight gone down. So okay, so this should benefit, but your cost has gone up. So
it has come down. That is what I'm saying. From other expenses of 80 crores to 55 crores.
Okay.
Where has it come down? I'm confused with it.
Thank you. We take the next question from the line of Viraj Shah from Shah Investments. Please go ahead, sir.
Yeah, hi, sir. Sir, just wanted to follow up on one of the participants' question. What would be our strategy for capturing the North American market, and have we secured any notable partnerships over there?
We have all the approvals in place, as I mentioned. Now it all depends about getting the allocations.
Okay. And sir, regarding Europe, when do we expect things to normalize over there? If you could share some timeline or something like that.
I would love to. If I knew, then I would do a lot of things.
Sir, any update or any extent we are seeing realization decline given by the China inventory build-up and decline demand from the Europe?
I think all these issues have already played out in the market. Whether they continue to play out further is a matter of speculation. But I think most of it has already played in the market.
Okay. And sir, if we get any updates on demerger front, what are we at current stages?
So currently, our demerger application is pending before the NCLT, and we await their approval.
Okay. Okay, that's it from my side. Thanks.
Thank you, sir. The next question is from the line of Mr. Jigar Shah from AK Securities. Please go ahead, sir.
Yeah, hello, sir. Sir, I just had one quick question. What is our debt strategy and going forward, and can you share a timeline that when we can reduce it further?
Reduce what?
Debt.
Reduce. I think Akshat has already said that we did already prepay debt in the first half. In fact, in the first half, we paid a debt of 25.5 crore rupees. And in the second half, because of the prepayment of most of the debt which was due in the second half also, and about 4.5 crore of the debt which was due after 31st March 24 also. So in the next 6 months, it should reduce by a further 10 crores, 10.35 crores. So our long-term debt is already substantially lower than what it was at the beginning of the year, which was at 104.09 crores, and which is at 78.5 crores as on 30th of September. And it should further reduce by about 10.5 crores by the end of the year.
Very sir. That helps. Thank you, sir.
Yeah.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to the management for closing comments.
I'd like to thank everyone for being part of this call. We hope we've answered your questions. If you need more information, please feel free to contact us or Mr. David Dhruva from SGA, our IR advisor. I'd also like to extend my heartfelt wishes for the upcoming festive season. Thank you so much.
Thank you.
Thank you. On behalf of Oriental Carbon and Chemicals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.